wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets so that you can better understand how the markets operate and also to help you identify the current trends in the market so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 203, and in this episode we're reviewing the performance of the financial markets during the 10th week of 2026, and that is from Monday the 9th to Friday the 13th of March. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where prices consumers pay for a broad range of goods and services rose in line with expectations for February, offering a final outlook at inflation pressures before an oil shock tied to the ongoing war in the Middle East rattles the current outlook. According to the Bureau of Labor Statistics data that was released on Wednesday, the Consumer Price Index increased by a seasonally adjusted 0.3% for the month, putting the 12-month inflation rate at 2.4%, which was in line with market expectations. Stripping out volatile food and energy prices, the Core Consumer Price Index posted a 0.2% monthly gain, whilst the annual rate came out at 2.5%. However, the Federal Reserve's preferred measure of inflation, that is the Personal Consumption Expenditures Price Index, this increased by 0.3% for the month and by 2.8% on an annual basis, whilst the Core PCE Index, which excludes food and energy prices, this rose by 0.4% for the month and by 3.1% on an annual basis. The annual rates of inflation remain unchanged from January, indicating that inflation was holding above the Federal Reserve's 2% target rate. Staying in the United States, U.S. consumer spending increased at a solid pace in January amid higher prices as the ongoing conflict in the Middle East threatens to add to inflation, bolstering expectations that the Federal Reserve would hold out on cutting interest rates before September. Despite the slightly larger than expected increase in spending that was reported by the Commerce Department, other data on Friday hinted at downside risks to economic growth after the gross domestic product data showed a decline in growth in the fourth quarter that was sharper than initially anticipated. Following in the wake of unexpected job losses in February, the GDP report poses a dilemma for the U.S. Central Bank. Economists expect the Fed to keep its benchmark overnight interest rates on hold during its policy meeting next week on Wednesday as financial markets anticipate a single rate reduction this year, most likely in September. For your information, consumer spending accounts for more than 2/3 of U.S. economic activity. Staying stateside, data from the Treasury Department showed that the U.S. budget deficit surpassed $1 trillion for the current fiscal year through to February, but was sharply lower than for the same period a year earlier. Spending exceeded revenues by $308 billion in February, roughly in line with the deficit recorded in the same month 1 year ago. For the current fiscal year to date, the deficit totaled to $1.004 trillion, about 12% lower than the comparable period in 2025, as government revenues rose faster than spending. Helping to narrow the gap was a sharp increase in tariff collections, as customs duties totaled to $151 billion through the first 5 months of the current fiscal year. However, the recent Supreme Court decision striking down many of President Trump's tariffs has not yet shown up in the data. And remaining in the United States, the Commerce Department reported on Friday that economic growth in the United States came in much slower than expected in the final 3 months of 2025. According to the department's Bureau of Economic Analysis, the gross domestic product, which is a measure of all the goods and services produced across the United States, these rose at a seasonally and inflation-adjusted annual rate of just 0.7% in the fourth quarter of 2025. This first revision of the GDP reading was a sharp step down from the previous estimate of 1.4% and well below the Dow Jones consensus forecast for a growth of 1.5%. It also marked a considerable slowdown from the 4.4% growth that was recorded in the third quarter of 2025, which was hampered by the longest government shutdown in U.S. history. And for the full year 2025, the U.S. economy posted a growth of 2.1% compared to an expansion of 2.8% in 2024. And over to the United Kingdom, where the UK economy flatlined in January as growth continued to slow down, and that was even before the impact of the ongoing conflict in the Middle East filters through the economy. Preliminary data published on Friday showed that the UK economy did not record any growth in January, falling short of the 0.2% month-on-month growth that was forecast by economists polled by Reuters. In the final quarter of 2025, the UK economy grew by a weaker than expected 0.1%. Britain's Office for National Statistics said that the dominant services sector showed no growth in January, whilst production contracted by 0.1% and construction grew by 0.2%. On Wall Street this past week, the S&P 500 fell on Friday while oil prices extended their gains as investors awaited further developments on the ongoing conflict in the Middle East. Stocks came off a losing session as oil spiked in the previous session after Iran's new supreme leader said that the Strait of Hormuz would remain shut as a tool to pressure the United States. The broad-based S&P 500, which scored a new low for 2026 on Friday, posted a 1.6% loss this week and notched its first 3-week losing streak, closing at 6,632. Meanwhile, the 30-stock Dow Jones Industrial Average slid about 2% during the week before settling at 46,558. And the tech-heavy Nasdaq Composite fell by 1.3% for the week to eventually close at 22,105. In the government bond market, the yield on the 10-year Treasury bond was little changed on Friday as investors weighed the release of the downwardly revised fourth quarter growth numbers that came out much lower than expected. Investors reacted to a much slower economic growth of 0.7% in the fourth quarter of 2025 compared to the previous estimate of 1.4% that was originally reported by the Bureau of Economic Analysis. The report came ahead of the Fed's two-day policy meeting, which ends on Wednesday this coming week, and where, according to the CME's Fed Watch tool, traders are largely expecting the Fed to keep its policy rate on hold this time around. The yield on the short-dated 2-year Treasury note slid by more than 2 basis points to 3.73%, whilst the yield on the benchmark 10-year Treasury bond rose more than 1 basis point to 4.28%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions. In the commodity markets, Brent crude closed above $100 on Friday for the second consecutive session as the war in the Middle East enters its third week, as traffic through the Strait of Hormuz remains at a standstill. Despite measures to contain the price of crude, such as the agreement by the International Energy Agency to release a stockpile of 400 million barrels of oil into the open market, the price of oil continues to remain at elevated levels. In addition to that, the U.S. has authorized the temporary purchase of Russian crude oil, which was stranded at sea, in order to stabilize the energy markets. Traders are continuing to monitor developments in the Middle East as President Trump hinted that an end to the conflict was not imminent. Oil prices have notched another week of gains, with Brent crude rising about 10% to close at $103.14 per barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, ended the week more than 8% higher to settle at $98.71 per barrel. In the precious metals market, gold prices slipped on Friday and were on track for a second consecutive weekly decline, pressured by a stronger dollar and inflation worries that are driven by the ongoing war in the Middle East, and which in turn have weighed down on rate cut expectations. Commerzbank, in a note to clients, said that the expectations of a more restrictive monetary policy are the main reason why the price of gold has recently come under pressure. Data showed that U.S. consumer spending increased slightly more than expected in January, which, together with the ongoing war in the Middle East and the potential impact on underlying inflation, has bolstered the view that the Federal Reserve would not resume cutting interest rates in the near term. The price of spot gold was down over 2% for the week before settling at $5,052 per ounce. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling remained extremely stable versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.30. Meanwhile, the sterling pound was priced at 173.59 and the euro was valued at 149.97. And on the regional front, one Kenya shilling was changing hands for 28.80 Ugandan shillings and 20.10 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.28. The IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by $136 million for a grand total of $14.46 billion, which is equivalent to 6.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The massive increase in forex reserves to above $14 billion was attributed to the recent issuance of a dual tranche Eurobond for $2.25 billion, part of which was used to buy back existing Eurobonds that are approaching maturity. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On foreign exchange remittances, the inflow of remittances into Kenya totaled to $412 million in February 2026, and this was an increase from the $382 million that was received in February 2025, which was an increase of 8%. Meanwhile, the cumulative inflows for the 12 months to February 2026, this increased by 1.9% to $5.05 billion. The inflow of remittances has become the main source of foreign exchange earnings for the country and continues to support the balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined by 6 basis points to 8.66%, which is slightly below the revised central bank rate at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, these averaged at around 37.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 12th of March, and the central bank received bids totaling to 43.7 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 182%. The central bank ended up accepting a 32.2 billion shillings, and the results of the auction were as follows. The 91-day rate was a tad bit lower at 7.56%, whilst the 182-day rate ticked up by 2 basis points to average out at 7.84%, and the 364-day rate declined by 16 basis points for a weighted average rate of 8.48%. In the primary bond market, the monthly Treasury bond auction was held on Wednesday, the 11th of March, and the central bank received bids totaling to 117.4 billion shillings against an advertised amount of 60 billion shillings, representing a performance rate of 195%. The central bank, however, ended up accepting 60.9 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2019 and now has 13.1 years left to maturity, the central bank accepted 44.8 billion shillings at a weighted average rate of 12.74% compared to the bond's coupon rate of 12.87%. And for the second bond, which is a 25-year bond that was initially issued in 2021 and now has 20.1 years left to maturity, the central bank accepted 16.1 billion shillings at a weighted average rate of 12.94% compared to the bond's coupon rate of 13.92%. Up next is our topical issue, and this week we're looking at two issues, and the first is the debut of the Kenya Pipeline shares at the Nairobi Securities Exchange. The Kenya Pipeline initial public offering closed on the 24th of February 2026 with a subscription rate of 105.7% and managed to raise a target amount of 106.3 billion shillings for the government. Kenya Pipeline shares opened for trading on Tuesday morning and immediately rose by 3.3% to trade at 9 shillings and 30 cents per share compared to the initial public offering of 9 shillings per share. Kenya Pipeline became the first initial public offering at the Nairobi Securities Exchange in 11 years and the first state divestiture in nearly 2 decades since Safaricom way back in 2008. Kenya Pipeline Company is now the 6th largest firm at the Nairobi Securities Exchange after its shares traded marginally higher on the firm's stock market debut. The stock closed for trading on Tuesday at 9 shillings and 18 cents per share, valuing the firm at 166.8 billion shillings. The second issue is on the plan by Kenya Mortgage Refinance Company to issue a green bond in April 2026. The Kenya Mortgage Refinance Company is scheduled to return to the market with a sustainability-linked bond sale in April. This will be the second green debt issuance in the past 4 months, coming shortly after Safaricom issued a 40 billion shilling bond in December 2025. For your information, a sustainability-linked bond refers to a debt whose proceeds are exclusively earmarked for projects that are considered to be environmentally friendly. Plans are at an advanced stage for the company to top the market once again, 4 years after its debut bond issuance in February 2022, where the company previously managed to raise 1.4 billion shillings. The total value, tenor, and pricing of the planned bond issuance are yet to be finalized. However, the company is banking on the current low interest rate environment in order to unlock cheaper financing from the capital markets and support the growing demand for green certified construction across major urban centers. The Kenya Mortgage Refinance Company is also relying on the tax-free incentive that is attached to sustainability-linked bonds in order to attract a wider pool of investors. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. And once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, you miss 100% of the shots that you don't take. A quote by Wayne Gretzky. Think about it. Thank you, and God bless.